Okay, so the presumption here is that you have already listened to the Chapter 5 lecture. So we're going to go through a bunch of different examples on the Chapter 5 material. Okay, so in our first problem, Wahlberg Associates purchased the contents of an estate for $75,000. The terms were FOB shipping point, which means Wahlberg is responsible for the cost of transportation, which they tell us was $2,400. Wahlberg Associates insured the shipment at a cost of $300. Prior to putting the goods up for sale, they cleaned and refurbished them at a cost of $980, and so we're supposed to determine the cost of inventory acquired from the estate. So, first we have the cost of the contents of $75,000. Then we're going to add the cost of shipping because they're responsible for it. And then the cost of insurance of $300. And then the clean and refurbishment of them for $980 rather. So our total inventory cost is $78,680. Okay, so same problem here. Why don't you pause the recording, take a try at it, and then when you think you're finished, you can resume the recording and we'll go through the answers. All right, so there's all of our costs. And the question is, what do we include in inventory and what do we not include in the cost of inventory? So the contents, $71,000 are included, so is the shipping, and so is the insurance, and then the cleaning and the refurbishing is also included because the cost of inventory includes everything needed to get the goods in saleable condition, so to speak. Okay, so our total cost is $73,450. All right, so moving on to the next problem. Laker Company reported the following January purchases and sales for its only product. They use the periodic inventory system, so that means they're valuing items at the end of the period. And they ask us to determine the cost assigned to the goods sold using the specific identification weighted average, LIFO, and FIFO methods. Okay, so under the specific identification method, they want us to determine the cost assigned to ending inventory and to cost of goods sold. And they tell us that we have 180 units from the January 30th purchase, 5 from the January 20th, and 15 from beginning inventory. That's what consists of or makes up our ending inventory balance. So they tell us we have 200 total units and ending inventory. 180 are from the January 30th purchase, 5 are from the January 20th purchase, and 15 are from beginning inventory. So beginning inventory had a unit cost of 6. So if we had 15 in ending inventory, that means we have 125 in cost of goods sold, right? 125 plus 15 is 140. Then we have 55 units left, or rather in cost of goods sold from our 5 in ending inventory. So we started with 60. They tell us we have ending inventory of 5, so that means we have 55 in cost of goods sold. And we have all 180 of our January 30th in ending inventory, so we didn't sell any of those, okay? So if you take each of those times the cost, it means we have cost of goods sold of 1,025. If we take each of those in ending inventory times the cost, it means we have $925 in ending inventory. Okay. Under the weighted average, first we have to determine what our average cost is. Our average cost is determined by the number of cost of goods available for sale divided by the number of units. So we have $1,950 divided by 380 units. So our average cost per unit is $5.13. Okay. So if we take $5.13 times the 180 units that we sold, that means our cost of goods sold is $923.40. If we take $5.13 times the 200 units that remain, so our 380 minus our 180, we're going to have ending inventory of $1,026. Oh, and then the difference they're saying is due to rounding. All right, so if we're using the periodic FIFO method, that means that our first costs in are also the first costs that we sell or that flow through cost of goods sold. So we have 180 units that we've sold at retail. They're pulling that from here, which means we have 140 from our beginning inventory that are all going to be sold. Those were the first units. Plus we need another 40 to get to 180. So 40 of our 60 units from our January 20th purchase are going to be sold. We're not going to sell any of our January 30th. So that means our ending inventory, beginning inventory of 140 minus 140, we have 0 left from our beginning inventory. We have 20 left from our January 20th purchase. And we have 180 left from our January 30th purchase. Okay. So if you apply the cost to each of the rows and add up the costs, that means our cost of goods sold is $1,040 and our ending inventory is $910. Okay. So under LIFO, periodic LIFO, the most recent purchases, the cost of those are going to be the first costs that flow through our cost of goods sold. So in this case, we're selling 180 units total, right? So they tell us up here. Which means we're going to sell all 180 from our January 30th purchase. That's the latest one. And we're going to sell 0 from the others, which means we have 140 left in our beginning inventory. We have 60 left from our January 20th purchase, and we have 0 left from our January 30th purchase, right? So these units here in the available for sale column are the sum of the units that are listed here and the units that are listed here. So if we sell all 180 here, 180 minus 180 is 0. That's how I'm doing that, okay? So we've got 200 units left in an inventory. We started with 380, we sold 180, the difference is 200. So if you apply your costs to each of your rows, we have cost of goods sold of $810, and we have ending inventory of $1,140. So it's just using these unit costs here and multiplying them by each of the units here, okay? Okay, so same problem, different numbers. So under the periodic inventory system, determine the cost assigned to specific identification to cost of goods sold using specific identification, weighted average, LIFO, and FIFO. And then for the specific identification, your ending inventory consists of 250 units this time, 160 from January 30th, 70 from January 20th, and 20 from beginning inventory. So why don't you pause the recording, take a few minutes, attempt to compute the cost of goods sold and the ending inventory for each of these scenarios, and then when you're finished, resume the recording and we'll go through the answers. Okay, so under the specific identification, we have 260 units that are sold, which means we've got 250 left in the ending inventory. 510 less 260 is 250. They tell us that for specific identification, our ending inventory has 160 units from the January 30th purchase, 70 from January 20th, and 20 from beginning inventory, which means 200 available for sale less 20 is 180 in cost of goods sold. 150 less 70 is 80. 160 less 160 in ending inventory is 0. And then if you apply your costs for each of those to both your cost of goods sold and your ending inventory, you got 180 units times $7 per, $1,260. 80 times 680 is 544. 0 times 590 is 0, so we have cost of goods sold of 1,804. Same method to your ending inventory. So you have ending inventory of $1,560. Right, under the weighted average method, we compute our average cost. So if you take your cost of goods available for sale, that's your $3,364, divided by the number of units available for sale of 510, you have an average cost of $6.59, almost $6.60 per unit. And then if you apply your $6.59.6 to your total units in cost of goods sold, which would be 260 units sold at retail here, you have cost of goods sold of $1,714. And then if you apply your $6.59.6 to your ending inventory, which would be your 510 units less your 260 units, is 250 units, right? Times the per unit average cost, that's $1,649. All right, under periodic FIFO, we know we have 260 units left in ending inventory, or I'm sorry, in cost of goods sold. We know we have 250 left in ending inventory. 510 minus 260 equals 250. They tell us if we sold 260 units, we're going to sell all of our beginning inventory first, FIFO. So that's 200. You need another 60 units to get to 260. So we're going to sell 60 of our 150 units that we purchased in January on 20th. Which means we have 0 left in our beginning inventory and we have 90 left in our ending inventory. 150 less 60 is 90, right? And then we have 160 left from our purchase on January 30th. Then you apply your cost. 200 times 7 is 1,400. 60 times 680 is 408. We have no cost of goods sold related to our January 30th purchase because they're all still sitting in ending inventory. So we have cost of goods sold of 1,808. Same idea in ending inventory. Ending inventory value of 1,556. Then under LIFO, we're going to sell our latest cost first. Well, we know that we had to sell 260 units because that's how many that are here in this column, units sold. So if we're doing LIFO, we're going to sell all 160 of our January 30th purchase. And then we need another 100 to get to 260. So we're going to sell 100 of our 150 from January 20th. So that means we have 50 units left from our January 20th purchase because 100 plus 50 is 150 total, right? We have all 200 left of our beginning inventory still sitting in ending inventory. 0 from our beginning inventory were sold. The 100 that we sold from January 20th at 680 per. All 160 of our January 30th purchase at 590 per. Total cost of goods sold of 1,624. Total ending inventory of 1,740. Okay, so hopefully you did well on those. Let's move on to the next. All right, so Laker Company reported the following January purchases and sales data. They use a periodic inventory system. They want us to complete the comparative income statements for the month of January using the 4 inventory methods. We're supposed to assume that expenses are $1,250 and we have applicable income tax of 40%. So for specific identification, ending inventory consists of 200 units, 180 from January 30th, 5 from January 20th, and 15 from beginning inventory. So our sales are going to be the same on all 4 methods, right? $2,700, that's what they tell us here. Our cost of goods sold under specific identification we'll come back to. We know our operating expenses are $1,250. They tell us right here, so that's the same for all four methods. So under specific identification, they tell us that we have 180 units from the January 30th purchase still sitting in ending inventory, 5 from January 20th, and 15 from beginning inventory. So you take all of those units times the cost of each from over here, which means we had an ending inventory of $925. So we have 140 units less 15 equals 125 in cost of goods sold from beginning inventory. 60 minus 5 is 55. We didn't sell anything from our January 30th, so we have $1,025 in our cost of goods sold under specific identification. So we pull that one down. Gross profit is equal to sales minus cost of goods sold. So we have gross profit of $1,675 less operating expenses of $1,250 is $425. Tax is going to be $425 times 40% or $170. $425 less $170 is net income of $255. So then under weighted average, our average cost is our $1,950 divided by our 380 units, or 513 per unit. 513 times 180 units sold is cost of goods sold of $923. Ending inventory, it's 200 units, 380 minus 180, times average cost, $1,026. So if we wanted to complete our income statement, we'd have 2,700 minus the 9, 2340, for a total gross profit of 1,776, less operating expenses. Income before tax of 526.60 times 40%, or $210.64 of tax expense. 526 of income before tax less the tax expense is 315.96 total net income. Under periodic FIFO, we have 180 units sold. We're going to sell our first units first. So we're going to sell all 140 of our beginning inventory. We need another 40 to get to 180, so we're going to sell 40 of our 60 from January 20th purchase times the costs, right? It's 840 plus 200, or $1,040, which means you have 0 left in beginning inventory. 60 minus 40, you have 20 left in from your January 20th purchase. And then your January 30th purchase, you have all 180 left sitting in your ending inventory for a total ending inventory value of 910. For purposes of this problem, really all you need to know is the cost of goods sold. So we're going to, under FIFO, have cost of goods sold of $1,040. Sales minus cost of goods sold is gross profit of $1,660. Less operating expenses of $1,250. Net income before tax $410. Times 40% tax $164. 410 less 164 is $246. Then lastly, under FIFO, we're going to sell all of our most recent purchases first, right? So all 180 that we sold are going to come from our January 30th purchase. 180 for 50 is 810. So our cost of goods sold is going to be 810. 2,700 minus 810 is 1,890, minus 1,250 is 640, times 40% tax is 256. 640 minus 256 is net income of 384. Okay? All right, so there's our completed income statements comparing the net income of all four methods. So, which method yields the highest net income? Well, looks to me like LIFO, right? Does net income using weighted average fall between that of using FIFO and LIFO? It does not, right? 315 falls outside of, oh wait, I'm sorry, yes it does. Does 315 fall inside of 246 and 384? Sure does. If costs were rising instead of falling, what method would yield the highest income? It's FIFO. Here's why. If prices are rising, or I'm sorry, if costs are rising and you use the FIFO method, that means that the lowest costs are going to flow to your income statement first, which means your net income is going to be higher because your cost of goods sold is going to be lower. Okay? All right, so this is the same problem. Why don't you pause the recording, take a few minutes, complete this using each of the methods, and then when you're done, resume the recording, and we'll go through each of the answers. All right, so we know that our sales income is going to be the same under all four methods, $4,680. We know that our operating expenses are going to be the same under all four methods, $1,800. So if we look at specific identification first, 260 for our total units sold. We know that because that comes from here, which means 250 are left, right? 510 we started with, 260 we sold. So that means we have 250 left in ending inventory. They tell us our ending inventory has 160 units from the 30th purchase, 70 from January 20th, and 20 from beginning inventory. Which means 200 minus 20, we have 180 in cost of goods sold. 150 available for sale, less 70 is 80 for cost of goods sold. And then 160, we have all 160 still sitting in ending inventory, so we didn't sell any of those, so that's 0. Then you apply your cost for each of the lines, sum them up, 1,804 cost of goods sold. And then for ending inventory, same thing, sum them up, 1,560. So under specific identification, we're going to have cost of goods of 1,804. So we have gross profit of 2,876. That's your sales less your cost of goods sold. Operating expenses of 1,800. So that means we have net income before tax of 1,076. Tax expense of 30%, 323. For total net income of 1,000. Or I'm sorry, total net income 1,076 minus the 323, 753. Okay. Okay, so under weighted average, first we have to compute our average cost. So if you take your 3,364 divided by your 510 units, get a total cost, average cost of $6.59.6, right? So $6.59.6 times the 260 units that we've sold is cost of goods sold of $1,714.96. $6.59.6 times our ending inventory of 250 units, which is our 510 less our 260, gets us ending inventory of 1,649. So if we know that our cost of goods sold is 1,714.96 or 715, they're going to round here in the statement. 4,680 sales less 1,715 of costs equals gross profit of 2,965 less $1,800, income before tax of 1,165 less income tax expense, which is 30%. So 1,165 times 30% is 350. 1,165 less 350 is net income of $815. All right, under periodic FIFO, we're going to sell our oldest units or first purchased units first. So we know that we've sold 260 units. So that means we're going to sell all of our 200 units out of our beginning inventory. We need another 60 to get to 260, so we're going to sell 60 units of our 150. We're going to sell 0 of our January 30th. So if we started with 150 available for sale from our January 20th purchase, less our 60 sold, that means we have 90 left in ending inventory. We didn't sell any of our 160 from January 30th, so we have 160 left in our ending inventory from that purchase. Then if you multiply each by the cost of goods sold of 1,808, ending inventory of 1,556. So for completing our income statement, we have cost of goods sold of 1,808. So 4,680 less 1,808, gross profit of 2,872. Less expenses of $1,800, income before tax of $1,072, times 30% tax rate gets you income tax expense of $322, $1,072 minus income tax expense, net income of $750. Then lastly, periodic LIFO. We're going to sell our most recently purchased units first. So we're going to sell all 160 of our January 30th purchase. Then we're going to sell another 100 from our January 20th purchase, which means we have 50 left in ending inventory from that 150. We have all 200 left in our beginning inventory. Multiply each by the cost. Cost of goods sold of 1,624, ending inventory of 1,700. If we prepare our income statement using the LIFO method, we're going to bring down our 1,624, right? 4,680 minus 1,624 is gross profit of 3,056, less operating expenses of $1,800 equals income before tax of 1,256, times 30% income tax expense of $377, for total net income of $879. Okay. And so then if we're looking at all of our income statements together, which method yields the highest income? LIFO, right? Does net income using the weighted average fall between LIFO and FIFO? Does 815 fall somewhere between these two numbers? Sure does. If costs were rising instead of falling, which method would yield the highest net income? That'd be FIFO, right? If costs are rising, that means that the lowest costs or the first costs to go through your cost of goods sold. And if the first costs are if the first costs are flowing through your cost of goods sold and costs are rising, that means that the first costs are the cheapest, which means your cost of goods sold expense is lowest, which yields higher net income, right? All right, exercise 5.5. All right, so in this case, same idea. They're asking us to do the same thing as the last one, except for we're using a perpetual inventory system this time. What happened to my yellow highlighter? Perpetual inventory system, that's the only difference. And I think the number of units in our ending inventory are different. Okay. All right, so if we're determining the cost assigned to ending inventory and we're using specific identification this time, and it's a perpetual system, and our ending inventory consists of 200 units, 180 from January 30th, 5 from January 20th, and 15 from beginning inventory. We've got 180 units in our ending inventory from our January 30th purchase. We have 5 from our January 20th purchase. And we have 15 from our beginning inventory. That means we have 125 in our cost of goods sold because 140 less 15 is 125. We have 55 left, or 55 in our cost of goods sold because we started with 60. We have 5 left in ending inventory, they tell us, so that means we have 55 in cost of goods sold. We have 0 in our cost of goods sold from January 30th because all 180 are still sitting in our ending inventory. Apply your cost to each line. Sum your cost of goods sold, $1,025. Ending inventory, apply your cost to each line, which means we have a total of $925 in our ending inventory. Okay. So beginning inventory was $840. We purchased $1,110. That's our 810 plus our 300 up above, these two. We had cost of goods available for sale of $1,950, right? Our ending inventory is $925, which means our cost of goods sold is $1,025. Okay. All right, so determine the cost assigned to ending inventory using weighted average. So under the perpetual method, you have to compute your weighted average after every transaction, right? So on January 1st, we started with 140 units at $6 each. So, and we didn't sell anything on January 1st, so we have ending inventory of 140 units at $6 each, or $840. Then on January 10th, we sold 100 units, and our average cost was $6. So our cost of goods sold is $600. And so now our ending inventory, we have 40 left at an average cost of $6, or $240. Then on January 20th, we purchased 60 units at a cost of $5. So we have our 40 units at $6 plus our 60 units at $5, total of 100 units at $540. So $540 divided by 100 units is an average cost of $5.40. So then when we sell our 80 units on January 25th, we're going to use our average cost of $540. So we have cost of goods sold of $432, which means we have 20 units left at $540, or $108 in our ending inventory balance. On January 30th, we purchased 180 units at a cost of $4.50. So now we have our 20 units in our ending inventory at $5.40, or $108, plus our 180 units that we bought at $4.50 for $810. So we have 200 total units at a total cost of $918. $918 divided by 200 units is an average cost of $4.59. So we have cost of goods sold of $1,032. That's your 600 plus your 432. We have ending inventory of $980. So if we do our formula, beginning inventory of $840 plus our purchases of $1,110. So beginning inventory $840, purchases $300 plus $810 is $1,110. So we have cost of goods available for sale of this $19.50, right? Less ending inventory of $9.18 equals cost of goods sold of $1,032. Really, I think this is just the check, right? To make sure that you got the right answers up here. Okay, so if we're going to determine the cost assigned to ending inventory and to cost of goods sold using perpetual FIFO, we're going to start with our January 1st, 140 units at a cost of $6. So we have ending inventory, 140 units, cost of $6, or $840 total. Then on January 10th, we're going to sell 100 units. FIFO method, we're going to sell 100 units from our beginning inventory at a cost of $6 each, or $600 total cost of goods sold. Which means we now have, we started with 140, we sold 100, so we have 40 units left at a cost of $6, or $240. Then on January 20th, we purchased 60 units at a cost of $5. So now we have our 40 units remaining from this guy at $6, or $240, plus the 60 we bought at $5, or $300. So now our ending inventory is 100 units for a total of $540. Then on January 25th, we sold 80 units and under the FIFO method, we're going to sell the remaining 40 from our beginning inventory first at $6 each, and then we're going to sell another 40 to get to our total of 80 from the 60 at $5 each for a total of 200. So now we have 0 remaining from our beginning inventory. We have 20 remaining from the 60 that we purchased on January 20th at a $5 per unit cost. So we have $100 in our ending inventory. We have $440 total cost of that January 25th sale. And we have ending balance in ending inventory of $100. Then on January 30th, we bought 180 units at $450 each. So now we have 0 from our beginning inventory. We have 20 left from our January 20th purchase at $5 each. And now we have this 180 that we bought on January 30th at $450 each. So we have a total ending inventory of 200 units, which is the difference between this 180 and this, or this 380 and this 180, right? At a total cost of $910. If you add up your 600 and your 440, we have total cost of goods sold of $1,040. And if we do our double check with our formula, we have beginning inventory of 840. We have purchases of 1,110. That's your 300 plus your 810 for total cost of goods available for sale of $19.50. Less ending inventory of $910 equals cost of goods sold of $1,040. All right, under perpetual LIFO, we're going to sell the last units first, but we are going to sell the last units that were purchased just before each sale rather than waiting until the end of the month under the periodic system. So start with January 1st. We have 140 units at $6. It's all in our ending inventory. We didn't make any sales on January 1st, right? Then on January 10th, we sold 100 units. Last in, first out. Well, the last units we had were this 140. So we're going to sell 100 of those at $6. which means we have 40 left at $6. Then on January 20th, we purchased 60 units. So now we've got our 60 units we purchased at $5, which means our ending inventory has our 40 still left over from our January 1st, plus our 60 at $5 that we just purchased. So we have total inventory of 100 units at $540. Then on January 25th, when we make our next sale, the 80 units we sold, we're going to sell last in, first out. So the last in were these 60 units. So those are going to be the first ones we sell. So we're going to sell all 60 at $5, which means we need how many more to get to 80? We need 20. So we're going to sell 20 from our beginning inventory at $6 for a total of 120. Okay, so now we have 0 left at our $5 price point because we sold all 60 here. We had 40 at our $6 price point, but we sold 20 of those, so now we have 20 left. So our ending inventory is 20 units, total $120 balance. Then on January 30th, we bought 180 units for $450 each. So we have our 20 remaining from our beginning inventory at $6. We just bought 180. We have 0 left at our $5 price point, and then we just bought 180 at our $450 price point for $810, or a total ending inventory balance of $930. Total cost of goods sold $420 plus $600, $1,020. And if we want to check our balance, we have beginning inventory of $840. We bought purchases of $1,110 for $1,950, less ending inventory of $930 equals cost of goods sold of $1,020. Okay. All right, so same problem here. Why don't you guys take a stab at it, and then when you think you are finished and or you are stuck, you can resume the recording and we will go through the answers. All right, so under specific identification, let's pull down our beginning inventory and then our purchases. All right, so there's our available for sale column. So they tell us that we have 250 units left in ending inventory, right? And they tell us that 160 of them are from January 30th, 70 are from January 20th, and 20 are from beginning inventory. So that must mean 200 less 20 is 180. 150 less 70 is 80. 160 less 160 is 0, right? So there's all of our counts. Then if we assign our cost to each of them, so 180 at $7 is cost of goods sold of $12.60. 80 at $6.80, total cost of goods sold of $5.44. 0 at $5.90 is 0. So we have total cost of goods sold of $1,804. Same idea to ending inventory. Total ending inventory of $1,560. If we're going to check our work, beginning inventory was $1,400 plus purchases $1,020 plus $944. It's $1,964, which means our total goods available for sale is $3,364 less ending inventory of $1,560 equals cost of goods sold of $1,804. All right, so under the weighted average method, each time we compute our weighted average cost, right? So January 1st, we have 200 units at $7, which means our ending inventory is 200 units at $7. Then on January 10th, we sold 160 units. So 160 units at our cost of $7 is cost of goods sold of $1,120. which means we have 40 units left. 200 minus 160 is 40 units left in our ending inventory at a cost of $7 each, or a total of $280. Then on January 20th, we purchased 150 units at $6.80. So now in our ending inventory, we have our 40 units at $7 plus our 150 units at $6.80. Total units of 190. Total cost of 1,300. 1,300 divided by 190 is our average cost per unit of $6.84. So then when we make our sale on January 25th of 100 units, we're going to sell 100 units at our average cost of $6.84, which means we now have 90 units left. We started at 190, we sold 100, we have 90 units left. It's $6.84, or $616. Then on January 30th, we bought 160 units at $5.90. So we have our 90 units in our ending inventory at $6.84 plus our 160 we bought at $5.90. So we've got 250 total units at a total cost of $1,560, or an average cost in our ending inventory of $6.24. Our total cost of goods sold is $1,120 plus $684. So our beginning inventory of $1,400 plus our purchases of $1,964, that's this 120, or $1,020 plus our $944, equals $3,364 cost available for sale, less our ending inventory of $1,560 equals cost of goods sold of $1,804. All right, so if we look at perpetual FIFO, we've got beginning inventory on January 1st, 200 units at $7. So that's going to be in our ending inventory on January 1st, right? Then on January 10th, we sold 160 units. Under the FIFO method, we're going to sell all 160 from our beginning balance. So 160 of our 200 at $7 each. 1,120 cost of goods sold. 200 less 160 means I have 40 left in my ending inventory at $7 each, or $280. Then on January 20th, I purchased 150 units at $6.80. So I've got my 40 at $7 still in my ending inventory. I'm going to add to it 150 at $6.80 for $1,020. So I have total ending inventory of 190 units, and a total ending inventory cost of $1,300. Then on January 25th, I sold 100 units. So under last in first out, I'm going to sell all 40 that I have remaining here from my beginning inventory first, and then my other $60 that I need to get to 100, I'm going to sell from this 150 at my $6.80 cost. So then I have nothing left from my 40 beginning inventory, or my 200 less my 160 less my other 40 I had left. So I have 0 beginning inventory left at my $7 cost. And then I have 90 of my 150 left at my $6.80 cost, for a total ending inventory of 90 units at $612, and a total cost of goods sold of that 100 units of $688. Okay. Erase all my highlights here so we don't get confused. All right, so then moving on, we purchased 160 units on January 30th. So that's 160 at $5.90. I have 0 from my beginning inventory because I had 200. I sold 60. Then I had 40 left and I sold those 40 here. So I have 0 of my beginning inventory. Then I have 90 units left from my 150 that I purchased, because I purchased 150, and then here at 680 I sold 60 of those. So I've got 90 left at my $6.80 price point. And then I just bought another 160 at $5.90. So I have total units of 250 at a total cost of $1,156. Total cost of goods sold $1,120 plus $688, $1,808. So if I have beginning inventory of $1,400 plus my purchases $1,020 and $944, I have total costs available for sale of $3,364 less my ending inventory of $1,556 for a total cost of goods sold of $1,808. Okay. All right, and then lastly, determine the cost assigned to ending inventory using perpetual LIFO, So I'm not sure what is going on with my highlights here. All right. So I have 200 units at $7 each on January 1st. So that's going to be in my ending inventory. Then I made a sale of 160 on January 10th. I'm going to sell the last units in first. So in this case, I'm going to sell 120 or 160 rather of my 200 units at my $7 price point for a total cost of goods sold of $1,120. So I have 40 left at $7 or $280. Then on January 20th, I purchased 150 units at a cost of $6.80. So I have 40 left at $7. I'm adding to it 150 at $6.80. So my total ending inventory is 190 units at a total cost of $1,300. Then on January 25th, I sell 100 units. So last in, first out, I'm going to sell all 100 units from my $6.80 price point. So then I have 50 of those left, plus 40 from my beginning inventory at $7 for a total ending inventory of 90 units and $620. Then on January 30th, I bought another 160 units. So I've got 40 left from my beginning inventory at $7. I have 50 left from my $6.80 price point, or my January 20th purchase. And then I'm adding to it 160 units at $5.90 each. So I have total ending inventory of 250 or $1,564. And I have total cost of goods sold of $1,120 plus $680. So if I wanted to double check, I have my $1,400 beginning inventory plus my purchases of $1,020 plus $944. So I've got cost of goods available for sale of $3,364 less ending inventory of $1,564 for a total cost of goods sold of $1,800. Okay, so exercise 5-7. Hemming Company reported the following January purchases and sales data for its only product. So they want us to determine the cost assigned to cost of goods sold using LIFO and FIFO and compute the gross margin for each method. And we are under the periodic inventory system. So at the end of each period is when we're going to compute the cost, not along the way. Okay? Periodic FIFO. So beginning inventory was 200 units at $10 per unit. We sold 880 units during the period. So let's compute our cost of goods sold and our ending inventory. So under the FIFO method, we're going to sell our first units first. So that means we're going to sell all 200 of our beginning inventory. We're going to sell 350 from our March 14th purchase. So that's $550. We need another $330 to get to 880. So we're going to sell the next 330 from our 450 units that we purchased on July 30th. which means 200 less 200. We're going to have 0 left from our beginning inventory. We're going to have 0 left from our March 14th purchase. We're going to have 450 minus 330. We're going to have 120 units left from our 450 that we purchased on July 30th, and then we're going to have all 100 units left from October 26th. So we have 220 units left in ending inventory because we sold 880 and we started at 1,100. Okay. So if we apply our cost to each of those units sold and we add them up, our cost of goods sold is $13,850. Apply each of the costs to our ending inventory, add them up, total ending inventory of 4,900. So if we're going to compute our gross margin under the FIFO method, gross margin is computed as sales less cost of goods sold. So under the FIFO method, we have sales of 35,200. They give us that. We've got cost of goods sold of 13,850 for a gross margin of 21,350 under the FIFO method. So if we look at the same problem under the LIFO method, we know we sold 880 units. So under LIFO, we're going to sell the last units in first. So we're going to sell all 100 from October 26th, all 450 from July 30th. So that's 550. So we need another 330 to get to 880. So we're going to sell 330 of our 350 March 14th purchases, which means we have 20 left from our March 14th. We have all 200 left from our beginning inventory, and we have none left from our July 30th and our October 26th purchases. So if we apply our costs to each of the lines and sum them up, total cost of goods sold of $16,450. Add our cost to each of our units in ending inventory and sum them up. We have total ending inventory of 2,300. So if we're computing our gross margin under the FIFO method, or LIFO method, excuse me, we have sales of 35,200 less cost of goods sold of 16,450 for a total gross margin of 18,750. Same problem. Why don't you pause the recording, work through it yourself, and then resume the recording. And let's see how you did. All right, so under periodic FIFO, we're going to sell our first units first. So in this case, we know we've sold a total of 970 units, sorry. So all 300 of our beginning inventory, all 410 of our March 14th inventory, and 260 to get to the total of 970 of our July 30th inventory or purchase, which means we've got 240 left from our July 30th purchase. We started at 500. We sold 260, so we have 240 left. And then we have all 150 of our October 26th purchase because we didn't sell any of those, right? So if you take your number of units times your cost, and then you add all of those up, cost of goods sold of 15,480, excuse me. Then we apply our costs to our units in ending inventory, right? And add those up, we have ending inventory of 6,780. So under the FIFO method, we have total sales of 38,800. Total cost of goods sold under the FIFO method of 15,480. So we have gross margin of 23,320. Then under the LIFO method, we know we've sold 970 units. So that means we've sold all 150 of our October 26th purchase, all 500 of our July 30th purchase. And how many more do we need to sell to get to a total of 970? 320 of our 410 that we purchased on March 14th. Which means we've got 90 units left, our 410 less our 320. 410 less 320, 90 left. We have all 300 left in our beginning inventory for our total ending inventory units of 390. 390 is 1360 total, less what we sold of 970, right? So if you apply your cost to each of the lines, you get a total cost of goods sold of $16,320. Ending inventory, apply our cost to each of those for total ending inventory of $5,940. So we have total sales of $38,800 less our cost of goods sold of $16,320. Means we have a gross margin of $22,480. All right, so hopefully you did well on that one. Let's move on to exercise 5-8. So Hemming Company reports the following current year purchases and sales data. We're going to assume that ending inventory is made up of 45 units from March 14th, 75 from July 30th, all 100 from October 26th. Using the specific identification method, calculate cost of goods sold and gross profit. So they tell us what ending inventory is made up of. 220 units, 45 from March 14th, they told us, 75 from July 30th, and 100 from October 26th. And 0 from beginning inventory, right? Which means we have 200 from beginning inventory in our cost of goods sold. We have 305 from our 350 March 14th purchase in cost of goods sold. 350 less 45 is 305, right? 450 less 75 is 375. And 100 less 100 is 0. So if you apply your cost to each of those lines, our beginning inventory was at a cost of 10, so that's total cost of goods sold of 2,200 times 10. Our 350 units were purchased at $15. We sold 305 of them. So 305 at a 15 per unit cost gives us cost of goods sold of $4,575. 375 at a $20 unit cost, $7,500. 0 at a 25 cost is 0. So we have $14,075 of cost of goods sold. Our ending inventory, we have 0 units left from the $10 per unit beginning inventory, so that's 0. 45 left at a $15 cost, so 45 times 15 is $675. 75 units left in ending inventory at a $20 per unit cost, so that's $1,500. And then 100 units left at 25 per unit cost, or $2,500. You add those up, you get $4,675. So if we're computing our gross profit using the specific identification method, we have total sales of $35,200, less cost of goods sold of $14,075, right? It comes from here, we computed it. Total gross margin, or gross profit, same thing, of $21,125. Okay, so we have the same problem here, some different numbers. They want you to use the specific identification method to calculate the cost of goods sold and the gross profit. So here they tell us that assuming ending inventory is made up of 45 units from the March 14th purchase, 195 from the July 30th purchase, and 150 from October 26th. Using that information, why don't you pause the recording? Compute the cost of goods sold and ending inventory using the specific identification method, and then ultimately the gross profit. And when you think you are finished and or you are stuck, resume the recording and we will go through the answers. Okay, so we've sold 970 units. 970 units. We started at 1,360, so that means we have 390 left in ending inventory, right? And they told us what makes that up. 45 from March 14th, 195 from July 30th, and 150 from October 26th. Which means we've got in our cost of goods sold 300 units from our beginning inventory. If you take 410 minus 45, we have 365 in cost of goods sold from our March 14th purchase. We started at 500 on July 30th and we have 195 left, so that's 305 in our cost of goods sold. And then October 26th, we sold all 150, so that's 0. Then if you apply your cost to each of the lines, you have 300 units at $15 per, or $4,500. 365 at $16 per unit, or $5,840. 305 at 17 per unit, and 0 at 18 per unit. If you add those up, you get 15,525. If you apply your cost to your ending inventory, you have 0 at 15, 45 at 16 each, 195 at 17 each, and 150 at $18 each. You multiply across and then sum down. You have 6,735 of ending inventory. So they want us to compute the gross margin or gross profit. So we start with sales of 30,800, which they give us 38,800, which they give us at the top, less our cost of goods sold of 15,525 for total gross margin of 23,275. Okay, moving on to exercise 5-9. So Hemming Company reports the following current year purchases and sales data. They use a perpetual inventory system, and they want us to determine the cost assigned to cost of goods sold using FIFO and LIFO, and compute the gross margin for each method. All right, so under the FIFO method, we have beginning inventory of 200 units at a cost of $10 per. So that's going to go to our ending inventory because we didn't sell anything on January 1st. 200 units at $10 per for a balance of 2,000. Then on January 10th, they sold 150 units. Under the FIFO method, we're selling the oldest units first. In this case, all we have before January 10th is our beginning inventory. So we're going to sell 150 of those at the $10 cost per unit, or $1,500. So what remains is 50 units. We started at 200, we sold 150. So we have 50 in our ending inventory at a cost of $10, or $500. Then on March 14th, we purchased 350 units at $15 each. So we have our 50 at 10 plus our 350 at 15, total of 400 units at a cost of $5,750. So then on March 15th, when we make that sale of 300 units, we're going to sell our first units first. So we're going to sell 50, oh, where's my highlighter? 50 at the $10 first, right? And then we need to sell another 250 to get to 300. So we're going to sell 250 of our $350 purchase here, right? At $15 each for a total of $3,750, which means we have 100 left. We started at 350, we sold 250, so we have 100 left at that $15 price point for a total ending inventory of $1,500. Total cost of goods sold of that March 15th purchase is your 500 plus your 3750. Total ending inventory after the March 15th purchase is 100 units at $1,500 each. Then on July 30th, we bought 450 units at $20. So we have 0 left from our beginning inventory at 10. We have 100 left from our purchase on March 14th at 15, and then we just added to it 450 at 20 bucks. So it's a total of 550 units. Total inventory balance of 10,500. Then on October 5th, we sold 430 units. So that 430 units under the FIFO method, we have no more left from our beginning inventory to sell. We have 100 left at the $15 price point. And then we need another 330 from our 450 purchase, right? At 20 bucks each for a total of 6,600. So we have 120 left. We started at 450, we sold 330, so we have 120 at that $20 price point left in our ending inventory. So we have total cost of goods sold of 8,100 bucks, total ending inventory of 120 units, or $2,400. Then on October 26th, we made another purchase of 100 units. So we have 120 left at our $20 price point, plus our 100 that we just bought at our $25 price point, which means we have total cost of goods sold of $13,850, which is our $1,500 plus our $4,250 plus our $8,100, and total ending inventory of $4,900. Okay. Okay, so under the LIFO method, January 1st, we have our 200 units at $10, which is also then in our ending inventory of January 1st because we haven't sold anything as of January 1st. Then we we make a sale on January 10th of 150 units. Our last units in are our first units sold. So we're going to take 150 of that 200 units here. We're going to sell 150 at our $10 cost for a total cost of goods sold of $1,500, which leaves 50 units at $10 in our ending inventory. And then on March 14th, we bought 350 units at a cost of $15. So we've got 50 units at 10 plus our 350 units at 15 for a total ending inventory of $400, or 400 units rather, at $5,750. Then on March 15th, we made a sale. And under the LIFO method, we are selling our most recent units first. So we made a sale of 300 units, and all 300 of those units are going to come out of this 350 because that's our latest purchase at $15 each for a total of $4,500 of cost of goods sold, which means we have 50 units left at our $15 price point, and we have our 50 units left at our $10 price point from this one right here for a total ending inventory of 100 units, or $1,250, and a total cost of goods sold of $4,500. Then on July 30th, we bought 450 units. So we've got our 50 at 10 and our 50 at 15, plus our 450 at 20, for total inventory of 550 units, or $10,250. So then when we make our sale on October 5th of 430 units, we are selling our last units first. So we're going to sell 430 of this 450 at 20 bucks each. A cost of 20 each, I should say, or $8,600, which means we have 20 left. 450 minus 430 is 20 at our $20 price point, plus our 50 left at our 15 and our 50 left at our 10. So we have cost of goods sold of 8,600, and we have total ending inventory units of 120 for a total value of 1,650. And then on October 26th, when we buy our 100 units, we've got our 50 at 10, 50 at 15, 20 at 20, plus our 100 at 25. So we've got total units we've sold of 880, plus 1,500, plus 4,500, plus 8,600. That's a cost of goods sold of 14,600. Total ending inventory of 220 units. If you sum all of those balances, 500, 750, 400, and 2,500, we have total ending inventory of 4,150. So if we compute our gross margin under that method, FIFO and LIFO methods, we know what our sales are because they tell us that. So back to a couple slides ago, we computed that our cost of goods sold under the FIFO method was $13,850. Our cost of goods sold just on this previous slide under the LIFO method was $14,600. So our gross margin under FIFO is $21,350, or our gross margin under LIFO is $20,600. All right, so now it's your turn. You know the drill. Pause the recording. See if you can't solve this problem on your own, and then when you are finished and or you get stuck, resume the recording and we will go through the answers. All right, so under the FIFO method, January 1st, we had 300 units at $15 each. So our ending inventory after January 1st activity is $4,500. We sold 240 units on January 10th at a cost of $15 each under the FIFO method. So 300 minus 240 means we have 60 units left in our ending inventory at a cost of 15 or 900 bucks. Then on March 14th, we made a purchase of 410 units at $16 each. So now in our ending inventory, we have 60 units at 15 plus our 410 units at 16 for a total of 470 units at $7,460 total cost. Then on March 15th, we sold 290 units. We are under FIFO, so we are selling our first units first. So first we're going to sell all 60 at our $15 price point. Then we're going to sell the remaining 230 at our $16 price point, which leaves us with 180 at $16. So that's a total cost of goods sold of $4,580 and total ending inventory of 180 units at $2,880. Then on July 30th, we purchased 500 units at $17 each. So now our ending inventory, we have 0 left from our beginning inventory. We sold all of those. We have 180 left at $16 each. And we just bought 500 at $17. So that's total units of 680, total cost of $11,380. Then on October 5th, we sold 440 units. Under first in, first out, we are selling our first units first. So we're selling all 180 at 16. We don't have any at the 15 to sell, right? So if we sell 180 at our 16 price point, we don't have any of those left now in our ending inventory. And then we need to sell how many more to get to 440? That's 260. So we're going to sell 260 of our 500 at $17. So we have 240 remaining at $17. So that's total cost of goods sold of $7,300. Total ending inventory of $4,080. Then on October 26th, we purchased 150 units. So we have 0 left in our ending inventory at our $15 price point, nor do we have any left at our $16 price point. We have 240 at our $17, and now we have 150 at 18 bucks. So we've got units sold of 970, that's our 240 plus our 290 plus our 440, at a cost of $3,600 plus $4,580 plus $7,300, or $15,480. We've got ending inventory, total units of 390, that's our 240 and our 150. Total cost of $4,080 plus $2,700, or $6,780. Under LIFO, beginning inventory, 300 units at 15 bucks. Then on January 10th, we sold 240 units. Last in, first out. We're going to sell 240 of our 300. That's the last in before our January 10th purchase under the perpetual method. So we have 60 left. Then on March 14th, we bought 410 at 16. So our ending inventory consists of the 60 that are left from our beginning inventory at $15, plus our 410 at $16. Total of 470 units, or $7,460 of cost. Then on March 15th, we sell 290 units under the last in, first out method. We're going to sell all 290 from our $16 price point. So 410 minus 290 means we have 120 left in our ending inventory at that $16 price point. And then we still have the 60 left from our beginning inventory at $15 price point. So that's 180 units at $2,820 in ending inventory. Then we purchase on July 30th 500 units at $17 each. So we have our 60 left at $15 plus our 120 that are left over from our $410 purchase at $16 plus our 500 now at $17. So it's a total of 680 units at $11,320. Then on October 5th, we sold 440 units. So under the last in, first out perpetual method, we're going to sell all 440 of those from our most recent purchase. So that's going to be the $17 price point, which means we have 60 left. We bought 500, we sold 440, we have 60 left at $17. All 120 at 16 and 60 at 15. Then on October 26th, we purchased 150. So we have our 60 at 15, 120 at 16, and 60 at 17. Now we're going to add to it in our ending inventory the 150 at 18. So under cost of goods sold for the whole month, if you add up your units sold, 240 plus 290 plus 440, that's 970. Add up our costs, 3,600, 4,640, and 7,480. Total cost of goods sold of 15,720. Ending inventory, if you add all these guys up and all these guys up, you get $390, or 390 units, I'm sorry, at a total of $6,540. Under the FIFO and the LIFO methods, they tell us our gross sales are $38,800. We computed cost of goods sold under FIFO to be $15,480. Under LIFO to be $15,720. So gross margin, $23,320 under FIFO and $23,080 under LIFO. Okay, hopefully you did well on that one. Let's move on to the next. So exercise 510. All right, so one of the other major topics of chapter 5 is this idea of lower of cost or market. So accounting rules would say that you have to report your inventory on your balance sheet at the lower of cost or market, right? So in this problem, they want us to compute for each individual inventory item, helmets, bats, shoes, and uniforms, the lower of cost or market. So they give us the units, they give us the cost per. We're supposed to compute the total and then pick which one we value or we report, or rather which cost we use to report our inventory on our balance sheet. So 24 units times a cost of 50 is total cost of $1,200. Same idea applied to bats. 17 units times a cost of 78. Shoes, 38 units times a cost of 95. And uniforms, 48 units times a cost of 36. So we have total cost of 7,648. Now if we take our total units times our market price, 24 times 54, 1,296. Total bats, 17 times a market per unit of 72, 1,224. Shoes, same thing. Uniforms, same thing. So we have total market of 7,490. So then the lower of cost or market applied to individual products, we're going to report our helmets at which one, cost or market? The lowest cost, right? Bats would be reported at market because that's lower. Shoes would be reported at market as well because that's lower. Uniforms are the same, doesn't matter. So our lower of cost or market would say we have to value our inventory at the $7,394. But we report our inventory initially at cost, right? So we'd be required to record a loss as an adjusting entry to take our cost of $7,648 down to our market value of $7,394. Okay? All right, so same problem, different numbers. Why don't you pause the recording? You know the drill. When you think you've finished it, you can resume the recording and we'll go through the answers. All right, so if we compute the total cost and total market for each of the line items, you take your units times your cost and then your units times your market, you should end up with these answers. And then, lower of cost and market applied to individual products, we'd report our helmets at cost, right? We'd report our bats at market. We'd report our shoes at market. And we would report our uniforms, either one. I mean, they're reported at cost. Same value as market. So we've got a total cost on our balance sheet currently at $21,058. It needs to be $21,337 or $20,337. And so we would report a loss of $721 as a year-end adjusting entry to bring our inventory in line with the GAAP accounting rules that say we have to report it at lower of cost or market. Okay, exercise 513. Use the following information for Palmer Company to compute inventory turnover for year 3 and year 2, and its days sales and inventory for December 31st, year 3 and year 2, and then comments on the efficiency in using their assets. So, in letter A, inventory turnover is computed as cost of goods sold divided by average inventory. Cost of goods sold for year 2 is $426,650 divided by its average inventory. So that's going to be $87,750 is the end of the inventory for year 2 plus $92,500 beginning of the year divided by 2. So that's going to be $91,125. So they are turning over their inventory 4.7 times in year 2. Days sales and inventory. Ending inventory of $87,750 divided by cost of goods sold of $426,650 times 365. So days sales and inventory are 75.1 days. We do the same thing for year 3. Inventory turnover, cost of goods sold is $643,825 in year 3, divided by average inventory, which would be your $97,400 plus $87,750. That's end of the year plus beginning of the year divided by 2 is the average. $92,575 or 7.0 times. Days sales, ending inventory of $643,825. Or I'm sorry, $97,400 is the ending inventory divided by cost of goods sold of $643,825 times 365, 55.2 days. Okay, same problem, different numbers. Why don't you take a few minutes, see if you can compute the inventory turnover and days sales and inventory for Palmer Company. And when you're finished, you can resume the recording and we will go through the answers. All right, so inventory turnover again is cost of goods sold divided by average inventory. So for year 2, their cost of goods sold was $351,650 divided by average inventory, which is going to be the end of the year inventory for year 2, $94,250, plus the end of the year inventory for year 1 of $99,000 divided by 2. So that's average of 96,625. Inventory turnover of 3.6 times. Then days sales in inventory. Ending inventory divided by cost of goods sold times 365. So you got 94,250 in year 2 divided by 351,650 for a total of 97.8 days. And then in part B, doing the same thing for year 3. Inventory turnover, cost of goods sold in year 3 is 568,825 divided by average inventory. So that's going to be your 103.9 ending inventory in year 3 plus your 94,250 ending inventory in year 2, which is also your beginning inventory of year 3 divided by 2. So that's 99,075 for 5.7 times the inventory is turning in year 3. And then in year 3, the days sales in inventory is ending inventory divided by cost of goods sold times 365. So year 3 has ending inventory of 103,900 divided by 568,825 cost of goods sold times 365 is 66.7 days. Okay, hopefully you did well on that one. Okay, exercise 516. So Dakota Company had net sales at retail of $260. They give us some additional information of beginning inventory and cost of goods purchased. And they want us to, using the retail inventory method, to estimate Dakota's year-end inventory at cost. So we know that beginning inventory at cost, 63,800, plus cost of goods purchased of 115,060 at cost, or 196,800 at retail, equals cost of goods available for sale, right? And they tell us our cost to, well, let me back up. Our cost of goods available for sale is 178,860. We have a cost to retail ratio of 55%. So if you take cost of 178,860 divided by 325,200, that's a cost to retail ratio of 55%. And they tell us that net sales at retail were $260,000. So that means our retail ending inventory is 65,200. So if we apply that 55% to 65,200, that means our ending inventory at cost is 35,860, which means our net sales at cost were 143,000. So why don't you take a minute and see if you can work through the same problem with different numbers, and when you're finished, resume the recording and we'll go through the answers. All right, so beginning inventory at cost and at retail, pull those numbers down. Cost of goods purchased, pull those numbers down, which means we have goods available for sale of 74,970 at cost, or 166,600 at retail. If you take your 74,970 divided by your 166,600, you have a 45% cost to retail ratio. So they tell us that we had net sales at retail of $150,000. So that means our ending inventory is 16,600 at retail times 45% means that it costs at 7,740 or 7,470, sorry. So if we back into our net sales at retail, that must mean it's 67,500. And we could also estimate our cost of goods sold by taking our cost of goods available for sale less our ending inventory is 67,500. All right, exercise 517. January 1st, shop had $225,000 of inventory at cost. In the first quarter, it purchased $795,000 of merchandise, returned $11,550, paid freight of $18,800. The terms were FOB shipping point. Company had a gross profit averages of 30%, and the store had $1 million of net sales at retail in the first quarter. So using the gross profit method to estimate the cost of inventory at the end of the first quarter. So we have sales of $1 million. Cost of goods sold, we're not sure, but they tell us that our gross profit averages 30%. So 30% of $1 million is 300,000, or if you know gross profit's 30%, sales have to be 100, so that means cost of goods sold has to be 70%. You can back into that $700,000. Okay? So then we know we have beginning inventory of $225. Net purchases is $802,250, so that's our $795 less our $11,550 plus our $18,800 gets us to $802,270 or $802,250, I think. Let me make sure. So we have $795 plus less $11,550 plus $18,800 should be, let me find my handy dandy calculator. 795 minus 11,550 plus 18,800. Yep, that's the 802,250 here. So we know that our beginning inventory plus our net purchases equals our cost of goods available for sale, less our cost of goods sold is 700, which we figured out up here. Means that our estimated March 31st inventory is 327,250. Okay. All right, so same problem, different numbers. Why don't you take a stab at it, and when you're done, resume the recording, and we will go through the answers. All right, so they tell us that the company had $2,180 of sales, and that their gross profit was approximately 40%. So that must mean that their cost of goods sold is 60%, right? So 60% times $2,180, $2,180,000 is $1,308,000. 2,180,000 minus 1,308,000 is gross profit of $872,000. And then if we want to estimate the cost of inventory, we know that inventory is equal to beginning inventory plus purchases. So they had beginning inventory of 630. Their purchases are 1,770,000 less returns of 24,900 plus freight in of 39,400. So that works out to be, oh, there's the math, 1,784,500. So beginning inventory plus net purchases equals cost of goods available for sale, 2,414,500. Less ending inventory, or less cost of goods sold equals ending inventory. So cost of goods sold of 1,308. So our estimated March 31st inventory is 1,106,500. All right, so hopefully you've done well on that. This concludes the exercise PowerPoint for Chapter 5. As always, if you have any questions, please feel free to send me an email or reach out, and I'd be happy to help you further. So best of luck with Chapter 5 homework, and let me know if you have any questions. Take care.